So, $50,000 a year. That's close to the average American income. And you want to know, honestly, what does that actually buy you right now in this market? I want you to really pay attention here because most calculators out there won't give you a real answer. They give you a rosy number, one that ignores half your actual monthly costs. There's an exact price range this income actually qualifies for, and I'm going to give you that number precisely later in this video. This involves debt-to-income math and several numbers that genuinely disagree with each other across sources. It's dense, and I'm not apologizing for that because dense is exactly what saves you from a rejection later. So save this video right now. There are three numbers that decide what $50,000 a year can actually buy you. Let's start with the first one. Okay, so let's clear something up first, immediately, because this is where most people get confused before they even start. $50,000 is not the median household income. That number is actually $83,730. Two very different figures, and mixing them up is exactly how people miscalculate what they can actually afford. And it's not the median full-time salary either, not by a long shot. That one runs $63,360 up to $65,052 depending on the source. Also higher. Also a completely different population entirely. So what is $50,000 exactly? It's closest to the median personal earnings figure across all workers, full-time and part-time combined. $51,370 per the Census Bureau. That's the number this video is actually built around. Objection! I know exactly what you're thinking right now. Isn't $50,000 just what everyone makes? No, it's not a household number, it's not a full-time number. It's an individual, blended number, and knowing exactly which bucket you're in matters enormously for what comes next. So know exactly which number you actually are before you start comparing yourself to anyone else's idea of affordability out there. A household earning $83,000 is playing a completely different game than an individual earning $50,000. Now, let's talk about the other half of this whole equation, the actual rates you're borrowing at today. That's exactly what's coming up next. Okay, so let's talk rates now, because this changes everything about what $50,000 can actually buy you. As of the week of August 13th, 2026, Freddie Mac's own weekly survey puts the 30-year fixed rate at 6.67%. The 15-year fixed sits at 5.96%. That's down slightly from the week before, but still up from 6.58% a year earlier. The Mortgage Bankers Association separately reports 6.77% for the week ending August 7th. Bankrate had it separately at 6.69% as of August 17th. Now, here's where it gets more specific and more useful for you. A lender survey from Money.com, mid-August 2026, breaks it out by loan program. Conventional, 6.52%. FHA, 7.23%. VA, 6.25%. Jumbo, 6.74%. 15-year, 5.85%. So why are rates sitting here, specifically? The 10-year Treasury note is at 4.69%. The spread between that and the 30-year fixed rate is 1.98%, which is actually above the historical norm of 1.5%. That wider spread is a real part of why your rate feels high relative to what Treasury yields alone would suggest. And I need to correct something here, because a lot of people are waiting for rates to drop significantly. According to LendingTree and most housing forecasters, that's probably not happening soon. Rates have hovered in that 6 to 6.5% range through most of 2026, and most economists expect year-end numbers landing right around 6.4 to 6.5%. So, roughly 6.5%, give or take. That's your refrain. That's the number driving everything in this video. Now, let's talk about what homes actually cost right now in this exact rate environment we just walked through. That's exactly what's coming up next. Okay, so what does a home actually cost right now, nationally, in this exact market? Let's get into it, and stay with me here. NAR reports the median existing single-family home hit $440,600 in June 2026. That's an all-time high, up 1.8% year over year. Their broader Q2 2026 figure, which is slightly different in scope, puts it at $434,900 instead. Census data tells a related but genuinely different story here. Their figure across all homes sold, including new construction, was $403,200 in Q1 2026, and new construction specifically, median $398,300 as of June. Now here's the number that actually matters most for you, right now, today. These national medians hide something enormous underneath them. Look at the regional breakdown instead. The Northeast sits around $494,500. The West, $613,400. But the South, $362,600. And the Midwest, just $315,500. That's really not a small gap either. That's nearly double between the West and the Midwest on the exact same national data. So, objection here. I know exactly what you're thinking right now. Is buying basically impossible on this income? Not necessarily, at all. And that regional gap you just heard, that's going to matter enormously later in this video when we talk about exactly where $50,000 actually stretches. But first, we need to talk about the real gap between what you actually earn and what the typical home actually demands from you. That's exactly what's coming up next. Okay, so the affordability gap. This is the number that explains why buying feels so hard right now, even with a decent income. According to Redfin's August 5, 2026 report, using June data, a household needs $109,796 in annual income to afford the typical U.S. home, defined as spending 30% or less of income on housing. Median household income is estimated at $87,599. So the gap right now is $22,197. Now, I need to be precise here because this is a household income figure, not the $50,000 personal income figure this whole video is built around. Don't conflate these two. They're measuring completely different things. The typical buyer actually spends 37.6% of income on housing, down from 39.3% a year earlier. And here's something worth knowing. That gap has been narrowing. $26,125 a year ago. $28,834 2 years ago. Narrowing because income is growing faster than home prices, not because homes are getting cheaper. NAR's own Housing Affordability Index confirms this trend, sitting at 105.6 in May 2026, up from 97.5 a year earlier, still well below the 160-plus readings that were common before 2022. And here's a quote worth remembering. NAR's chief economist Lawrence Yun said this in July. In smaller cities, particularly in the Midwest, $60,000 in household income is enough to buy a median-priced home. So now, let's actually do the math on $50,000 specifically. That's next. Okay, here's the math. This is the number I promised you back in the intro, and I want to be upfront. This comes from one lender's worked example, a AmeriSave, so treat it as illustrative, not an official government figure. A borrower earning $50,000 a year, that's $4,167 a month, gross, with no other monthly debts. Qualifying at a 43% back-end debt-to-income ceiling can support a maximum housing payment. Principal, interest, taxes, and insurance combined of approximately $1,792 a month. That supports a purchase price in the $215,000 to $245,000 range with a small down payment, slightly higher with a larger one. Now, let's talk about the actual rule behind this math. The standard guideline is 28-36. No more than 28% of gross monthly income on housing costs, front end. No more than 36% on total debt, back end. That's a guideline, not a law. And here's the correction I need to make, because real-world approval numbers run higher than that textbook rule. Conventional loans, automated underwriting commonly approves up to around 45%, stretching to 50% with strong compensating factors. FHA's published standard is 31 front, 43 back, but underwriting frequently approves into the high 40s, sometimes past 50. VA's guideline is 41%, but it's treated as more flexible in practice than that number suggests. So what actually moves that needle in your favor and gets you approved higher? A credit score above roughly 720, 6 or more months of mortgage payment reserves sitting in savings, loan-to-value below 75%, and a minimal increase versus what you're currently paying in rent each month. So $215,000 to $245,000. That's your refrain. That's the real number from the intro, finally answered. Now, what's layered on top of principal and interest that you haven't accounted for? That's exactly what's coming up next. Okay, so that calculator number, $215,000 to $245,000, that's not actually your final answer. There's more layered on top of principal and interest, and most people never see it coming. Property taxes. Median nationally, $3,500 a year. But this varies enormously. Effective rates run from 0.27% in Hawaii, all the way up to 2.23% in New Jersey, where the median annual bill is $9,541. West Virginia, by contrast, sits at just $728. Insurance. Estimates for 2026 cluster somewhere between $2,490 and $2,720 for $300,000 to $400,000 in dwelling coverage. I want to be clear, that's a range across multiple sources, not one fixed number. And here's something worth flagging. Insurance premiums have risen roughly 70% since 2021, driven primarily by reinsurance costs doubling, not just claims going up. There's also the hidden stuff: maintenance, utilities, the ongoing costs. One source estimates roughly $21,400 a year, and 81% of surveyed homeowners said these costs exceeded what they expected going in. And finally, mortgage insurance. Conventional PMI runs 0.46 to 1.5% of your loan annually if you're under 20% down, and it cancels automatically around 78 to 80% loan to value. FHA MIP is different, 1.75% upfront plus an annual premium, and it usually sticks around for the entire life of the loan. So the sticker price was never the real number, was it? Now, which loan program actually fits an income like this one? That's exactly what's next. Okay, so which loan program actually fits this income? Let's go through it quickly. Conventional, as low as 3% down. PMI if you're under 20% down, canceling automatically at 78 to 80% loan to value. Rates around 6.5 to 6.7%. FHA, 3.5% down with a credit score of 580 or higher. Mortgage insurance required for the life of the loan in most cases. Rates a bit higher, running 6.4 up to 7.2% depending on the source. VA if you're eligible, 0% down. No mortgage insurance at all, and the lowest rate of the bunch, around 6.25%. Now, down payment reality, and I want to flag a real discrepancy here, rather than pretend it doesn't exist at all. NAR's historical figure puts the typical first-time buyer down payment around 6%, but more recent lender-side sources are citing 10% as the current benchmark instead. These two numbers genuinely disagree. Don't treat either one as settled on its own. So where does $215,000 to $245,000 actually land you, geographically speaking? Back to that regional gap we covered earlier. The South and the Midwest sit closest to this range. Zillow's 5 lowest value states right now are West Virginia, Mississippi, Louisiana, Oklahoma, and Arkansas. West Virginia specifically sits at $182,288. Compare that to Boston, where a starter home runs $635,715, requiring $169,970 in income just to qualify at all. So on $50,000 a year, the map matters just as much as the math does. Okay, I know that was a lot of numbers and sources that don't always agree. But you stayed, and that matters because most people never actually run this math for themselves. So here's the exact refrain one more time. $215,000 to $245,000. That's the real range. $50,000 a year actually supports. The adversary here was never your income. It was rosy calculators and vague national averages, flattening everything that actually matters: your region, your debts, your down payment. So run your own numbers with your actual debts and your actual credit score, and get pre-approved before you fall in love with a listing sitting above your range. Now please like the video and subscribe to the channel, and I'll see you in the next video.